Hey YouTube, it's Matt Decker, Leveraged Wealth Management. I hope that you are doing well today. I have a bee in my bonnet, and so I just decided to record this quick video because today we are talking about something that's called the distribution solution. And I got this sent to me by a potential client because they had heard about it. It was proposed to them by, I believe, their CPA, and they wanted my opinion on it. And so they sent me this nice little handout. And I have seen this before, and it's never really made sense to me. I don't think it does much good. And when I looked through this PDF, which we're just going to kind of fly through, I just got more and more upset because there's just so many problems. And so I thought, you know what? I'm going to make a quick video because there's too many people out there that look at something like this. They drink the Kool-Aid. They think that it sounds good, but they don't check any of the numbers. They check none of the math. And this is just a disaster. I mean, this is a walking nightmare once you actually peel back the curtain and look at what's going on. So let's go through it. This distribution solution, what is it? It is a tax strategy. It's not actually a real thing. It's more of a marketing term. Okay, so you're not going to find distribution solution in like the IRS code or anything like that. It's a marketing term. What it is how can you get money out of your IRA, let's say, or profit sharing plan or qualified account? How can you get it out of there and minimize the taxable impact to you? That's what the distribution solution is. And so we've got this fancy marking, the retirement tax problem. What's the problem? Well, you've got $1 million account, and oh man, if you liquidate that entire account, which would be stupid, all at once. If you liquidate that entire account all at once, oh my gosh, you're going to have to pay $422,000 in taxes. You only have $577 left. What? That's a problem. Okay, first of all, nobody does that. That's stupid. If you have a financial advisor that's telling you to liquidate $1 million all in one fell swoop, probably time to get a new advisor. So then they've got some more, like, what is it? Oh, it's going to reduce your taxes. Is it? I don't know. We'll talk about it. It's going to eliminate your RMDs. Well, sure. If you want to pay almost $500,000 in taxes, you can eliminate your RMDs. Yeah, go for it. It's going to reduce your volatility. It's got tax-free legacy to beneficiaries, tax-free living benefits. And then they've got this thing about the Secure Act. Basically, what did the Secure Act do? Not removed. It extended your RMDs out to age 72. You can contribute past age 72 into some IRAs. It eliminates the stretch. Okay, that's all fine. Great. So what is it? What are we going to do? Well, we're going to take money, we're going to roll it into an IRA, and then when it's inside this profit-sharing 401k plan, we're going to take your money and we're going to pay it into a life insurance policy. And since the life insurance policy is still inside the 401k, see that? How the life insurance policy is inside, you can do that with what's called seasoned money. Don't worry about what that is. It doesn't matter because I'm going to show you that all these numbers are garbage. But with seasoned money, you can put IRA dollars into a life policy inside your 401k. Well, then you've got this life insurance policy, and all you got to do is this p.e.r.c value. You can basically take your life insurance policy and get it outside of your IRA. And that is a taxable distribution, but it's going to be less taxes is the sales pitch. Okay, it's going to be less taxes. Then you've got your life insurance policy owned outside of this plan, and you've got all these nice tax benefits. Okay, so I should pause. I really, really love life insurance for the tax benefits. All these things here are true. Tax-free death benefit, tax-free income, tax-free living death benefits. You could have added tax-free growth. All that is true. Life insurance can do that. For that reason, we recommend it to a lot of people here on this channel, especially high income earners. But that is not what's going on here. What's going on here is we're taking IRA dollars, we're putting it into a life insurance policy while the life insurance policy is still inside the qualified plan. At some point, you got to get that policy outside the qualified plan. And when you do that, you have a taxable distribution. You still have to pay taxes. Okay, so let's look at their numbers. Let's look at the taxable impact. So the one thing that you'll notice here, in this example, we have no ages. We have no idea how old this person is, okay? Which just, Oh, it's wonderful. It's a beautiful thing. We have no ages here, so we don't know how old the person is, but we do know because of this right there, just that's the only piece of information that they're giving us. We know that they are doing the premium funding over a 7-year period. At least that seems to be most likely. If they're not doing it over a 7-year period, I'm not sure why they're giving us an IRA balance for comparison in year 7. That wouldn't make sense. So let's assume it's a 7-year period. Fine. So you've got your $1 million IRA account. Over 7 years, it's going to grow, and your IRA balance is going to be 1.315. If you do the math on this, they're assuming a 4% rate of return, which is, again, hilarious to me. Why? Because of this box right here, and it says it's a 5% rate of return. It's not a 5% rate of return. It's a 4% rate of return. All you need is a calculator to figure that out. It's a 4% rate of return. You end up with 1.315 million. And oh my gosh, the retirement tax problem. Oh my gosh, you have $1.3 million in your 401k, and if you decide to convert all of that to an IRA in one fell swoop, you're going to pay over $500,000 in taxes. Okay, well, I did a video a couple years ago now on Roth conversion do's and don'ts. I'm fairly certain the first don't in that video is don't do it all at once. And of course, that's what they're showing here. So doing it all at once, you're going to pay $555,000 in taxes. That's terrible. Oh my gosh. Okay, so here's the solution. You're going to put that money over a 7-year period into a life insurance policy inside your qualified plan. So see, you've got your $999,000. That's all going into the life insurance policy. Okay, that's fine. That's great. Wonderful. And after 7 years, your life insurance policy is worth $943,000. Okay, so first of all, huge red flag. So you're telling me I'm going to put in $1 million and in 5 years, it's worth $943,000. So anybody with a brain can tell you that right off the bat, you're going to pay less in taxes if you decide to convert that because it's a lower figure, right? I mean, it's $943,000 versus 1.3. So are you telling me that you're saving me on my taxes because you're going to lose me money? Is that the sales pitch? You're going to save me on taxes because you're losing money? Apparently it is. $555,000 in taxes versus, oh, here, the tax on this $943,000 is only $398,000. We saved you $157,000 in taxes. Okay, I think I've beat a dead horse here. To me, that's pretty stupid. I don't understand the salesmanship of this at all. But here's what they're going to tell you. Oh, no, because this is why you want to do it. Because now you have this $943,000, which is really more like $500 and change. Let's just say it's $600,000, even though it's not. It's $500 and change. $600,000 after you pay these taxes. You got $600,000 in a life insurance policy, and now that life insurance policy has all these tax benefits, which is true. All that's true. Tax-free growth, tax-free death benefit, tax-free income, all of that is true on $600,000. Okay, now here's where it just gets outrageous to me. Again, I've already pointed out, we don't know how old this individual is, this example. Apparently, or I would assume that this is an actual person, right? They got to be in their 50s, I would think, because we're talking about, retirement. So let's just assume 50s or 60s. I think that's a pretty safe assumption. And we know that after they pay the taxes on this $943,000, let's just give them the benefit of the doubt and say that they're left with $600,000 in their life insurance policy. You'll notice on this chart, they don't give you any values until age 80. Okay, well, they're going to do the exact same thing on the next slide. So we don't know how old this person is when money comes out, when they make this taxable transaction and they go from $943,000 to $600,000. We don't know how old they are. But we do know at age 80, here's the next chart, at age 80, this blue bar, distribution solution, insurance cash value, we know that at age 80, their cash value is now $1.988 million. Okay, so again, if you have a financial calculator or Excel and you know how to use it, you can start to work backwards. We've got around $580,000, we got $600,000, let's say, in money in this life insurance policy. Once we pay this $398,000 in taxes, tax on per market value, $398,000, $943,000. Let's just go ahead and get the exact number here. $943,000, $864,000 minus $398,000, $783,000, $545,008. Right? This is my, what is this? My HP 10B2 plus, right? $545,000. So we'll just make it, let's make it official. 545,081. All right. That's how much money is in their life insurance policy. 545,081. We don't know how old they are. How old are they? We don't know, but we do know that $545,000, I'll put it here, 545,081, we know that is going to grow to 1.988 million at age 80. We know that's what it's going to grow at. Okay, so let's do some additional math here. You can go so far with a basic understanding of Excel and a basic to good understanding of how a financial calculator works, because we can kind of guess at how many years or what rate of return they're talking about here. So let's say that this person is 60 years old. Okay, so that means between 60 and age 80, that's 20 years. So if you have a starting value of 545,081, we know that our ending value is 1,988,511. We're not making any payments into this, right? We're just putting the money there. We're going to let it grow. We're going to let it grow for 20 years. What rate of return is that? It's about 7%. Okay, so if they're 60, it's about a 7% rate of return. Okay, so far so good. I don't necessarily have many complaints with assuming 545 at 7% over 20 years grows to 1.988 million. I mean, that's the math. That's how it works, about 6.68%. So let's just use 6.68. Let's make it official, right? I'm complaining about inaccuracies, 6.68%. So let's make it official. So if we do 6.68% every single year, this is the life insurance policy. 6.68% is the growth rate that they would have to have over a 20-year period to get to 1.988 million from 545. So 6.68%, we've got the same 20 years, and we know that this value right here, what's going on here? Well, let's figure out if we've got 20 years, we've got this 1,315,930. That's what our IRA grows to, right? 1.3 million. Okay, we're going to pay $500,000 in taxes, even though this is the wrong way to do it. So let's subtract out 555,981. So that means that over this 7-year period, your IRA has grown. It's 1.3 million. We're going to pay the taxes, convert it to a Roth. How much is left over? $759,000, 949. 759. 949. 759. 949. Here's the rub. Here's the problem. If we have 759,949 as our starting value, and we don't make any payments to that, and we use the same rate of return that they use for their life insurance policy, 6.68%, and again, 20 years, remember that's how long they must be 60, because otherwise the math, it doesn't work. 20 years, what does that grow to at 6.68% over 20 years? Well, it grows to $2.7 million. $2.7 million is what that Roth IRA grows to at the same rate of return as a life insurance policy. So surely they've got that right, don't they? Oh, no, they don't. What's going on? 1.15? What? So their Roth value, let me just get rid of this so we can see it. Their Roth value over 20 years, Roth conversion proceeds, is the greenish gold box. Their Roth proceeds is $1.152 million over 20 years. How's that possible? I mean, we're talking about 540 something here, right? That's what their life policy was worth, $540-some thousand. Their IRA grows to 759, right? Isn't that what we said? 759, or was it 749? I don't remember now. So their life insurance policy is getting a 6.68% rate of return, and it grows to 1.9 million. But their Roth that starts higher after you pay the taxes is only worth 1.15. What? Right. It's all BS. This whole thing is just completely wrong. Okay, so I'm beating a dead horse at this point, but I wanted to record this video because I saw it and it made me really upset because it just doesn't make any sense. And so I would just encourage you that if you're seeing things like this, double check the math. Make sure that you're looking at these values, that they make sense. Make sure that you're doing your own calculations, because it doesn't take much to notice that of course your Roth is going to grow to much more than 1.15 million if your life insurance policy is going to go from 600,000 to 1.9. Your Roth is going to go from 750 to obviously much higher than 1.15 million. Anyway, if you've seen this before, if you've been positioned this and you'd like for it to be reviewed, if you want a second opinion on it, reach out to me. I'll link my contact information kind of above and put a link below where you can just go to our website, fill out a contact form. I'd encourage you to do this. This has become a really hot topic amongst CPAs, positioning it to business owners. And I have yet to see one that makes much sense from a math standpoint. Certainly, there is a death benefit here. So if the goal is to take your IRA and buy as much death benefit as possible, then by all means. But I've never seen one positioned that way. I've never seen it positioned as take your IRA dollars and find a creative way to buy death benefit. Never seen that, not once. I've always seen it as take your IRA, get it into a life insurance policy where it's going to grow tax-free. You can use the income tax-free death benefit. That's how I've seen it positioned. So anyway, I hope that this was helpful to you. I hope that you just see that there's a lot of marketing terms out there, right? The distribution strategy. All you have to do with all these different strategies, because everybody has their own, coined marketing term or phrase, all you have to do with all these different strategies is get out Excel, get out a financial calculator, and just do some easy math calculations and double check their work. It's not hard to double check their work. It took me 5 minutes to take a look at this and know that something was wrong just by looking at these two values right here. I knew something was wrong, and some Googling and some YouTube on how to use Excel for future value calculations is very easy to do, and you can kind of be your own little sleuth. And the goal here is to save you from some heartache, right? To get hook, line, sinker on some strategy that maybe sounds good, but in reality, it's not really going to work that well. So hopefully this was helpful. If you've seen this as a strategy and you want a second opinion, go to my website, leveragewm.com/contact-us. You can fill out the web form there, and we'll be in contact with you. We can double check anything that you've been presented. But hopefully this was helpful. If you haven't done so already, subscribe to my channel, or at least consider subscribing to the channel. Share this video. Check out some other ones. Like this video. Let me know in the comments if you've seen this before, if this is the new strategy, or maybe I missed something. Maybe my math was wrong. I don't think it was, but maybe it was. And let me know. Anyway, thanks so much for joining me, and I look forward to talking with you soon. Take care.